we start off tonight with Apple dropping sharply from all-time highs after news it was reclosing stores in areas seeing an uptick in COVID cases. This comes at the end of a week when analysts were becoming increasingly bullish on this stock. There was RBC upping its price target to $390, saying the company is in a league of its own when it comes to share buybacks. Citigroup came out with a then street high price target of $400 on potential for Apple's yet to be released 5G iPhone and its services business. And today, a new street high from Jefferies, who thinks the stock can go another 15% higher from here. So what do we make of this bullishness, especially as there are still uncertainties about this U.S. economy? Pete Najarian, what do you say?
Well, I can understand the bullishness, Mel, just because of the fact that there are so many different verticals that Apple actually can tap into. So we're talking about services, we talk about wearables all the time. Even the Mac, which is almost a forgotten, continues to be something that's very strong. So there's so many different verticals that they've got. But when you start closing down stores, obviously there's going to have some effects. And I think people are going to react just like they did today. But I think in the longer term, we're still looking at a stock that because of the growth, and it's not just the phone like it once was. Even I think when we get around to the 5G, I think it's going to be more than just the phone. I think it's going to be some of the other categories, the App Store included. I think there's a lot of reasons to like Apple here. And I think it is. I think it's very legitimately a $400 stock in the 6 to 12 month range.
Is there any concern about selling a north of $1,000 iPhone, 5G iPhone later in this year, as we are seeing Beijing, for instance, deal with its own reclosures, Bonawyn? I mean, I don't. It's primarily a hardware company. If they can't sell those $1,000 phones, I don't know what happens to this story.
A fair point. Although I'd be less worried about Apple than I would about another company with much higher capex. Caterpillar, names like that, where it's like a much more of a durable goods purchase. I think Apple, in addition to the several verticals that were mentioned, I think it's more of like a trend. It's got a very sticky customer base, inelasticity of demand. And I really think the phone is more seen as a necessity now in terms of all the capabilities as opposed to a durable good. So I do see some differentiation there.
Defensive, it sounds like this thing is. I mean, everybody's going to, it's almost like a consumer staple, Jeff Mills. But what do you think of the valuation here?
Yeah, it's funny you guys bring that up because I wanted to mention the valuation. And number one, I agree with what Pete's saying. I've said it before, but it's worth repeating. You do have the wearables, you do have the services. They are going to be growth engines, and they're going to have to be because of the level of the valuation. But even given where Apple's trading right now, I think it's actually a stock that could do pretty well even if the market hits a rough patch. I've had my reservations about this market. I haven't been quiet about that. But even where it's trading right now, given its cash position, its strong balance sheet, its ability to continue to buy back stock, and it's going to continue to do that in the coming years, I think it does have a little bit of a defensive posture to it right now. The market was down 30% at the low year to date, and Apple was only down 23%. So we've seen that bear out in actual trading, and I do think that could continue. The one thing I would look at is, maybe China, if you have trade relations deteriorate there a little bit, or if you do have virus cases spike to the extent that you're worried about the economy, that's a potential problem. But I think just playing it on the momentum, on the breakout, and some of those fundamentals I mentioned, I still like it here.
Mike, your thoughts?
Yeah, so this is an interesting one. I actually have a small bearish position in Apple here, although I think people probably know that I began to get a little bit skeptical right after the stock started climbing out of those crisis lows that we saw and started to approach the all-time highs that we saw in February. That was about 327. That was about the price that I began to think, maybe we're fully priced in this thing here. I will say, with respect to the iPhone, that is a meaningful and important part of their revenues and their income, and it will be supported by 5G. Let's face facts. People who carry iPhones, and actually, I'm one of them, everybody in my family is, when they go 5G, we're all going to replace them. And what are we going to replace them with? We're going to replace them with Apple phones. The other thing is that the Mac, as Pete was just talking about, they have, it's a small slice of the market, but it's a growing slice of the market. We've seen just, marginal increases there, but it's a good margin business. So I think in that sense, it's a very safe company, and if you're thinking about the financials. But at 25 times forward earnings, I do think that it is fairly fully priced. And so my inclination would be, if you've been fortunate enough to take some big profits here and you didn't sell down at those crisis lows, that you might think about taking some profits.
All right. So a couple maybe questions about valuation. Pete, I have a question about services. Your favorite Apple analyst on the street is Katie Huberty, right?
Katie Huberty.
Katie Huberty. And she loves the services revenue, as do you, right?
Yes,
and,
yes.
And so my question is, what if regulators here in the United States or in the EU start saying to Apple, hey, you know what, take a look at how you deal with your app store and what you force developers to do and what you charge them, 15 to 30% of subscriptions, because you know what, Microsoft's president was complaining about that at an event today.
Yeah, that's pretty interesting. Obviously, that would be a hit, Mel. I think that would be something that certainly would be concerning, although I just wonder how much there is to this whole thing in terms of, are they going to be able to go after Apple? Because I've heard both sides of the story throughout the day on CNBC and a lot of great coverage of this sort of a topic of where does Apple go from now? Are they the big bad guy? Well, they are the big bad guy because they are so big. They own the space. And because of that, I still feel very, very comfortable about the services. I'd get a little less comfortable if they did start to regulate in some way, shape, or form. But the reality is, it was services, it still is services, but I'm still looking to wearables where they have incredible growth. That has caught up to, or at least catching up to the services in a very, very quick way. It hasn't gotten there quite yet, but getting very, very the growth there is incredible, and the margins, Mel. So the combination from the wearables, I think, is the place where I'm focusing even more now than it was years ago at the services. Now it's wearables.
Big tech going after big tech, though, Bonawyn. I mean, it was the Microsoft comments today that really caught my eye when Brad Smith said, this is worse than when we were found guilty of anti-competitive practices way back when, 1980s or whenever that was. This is worse. This is a worse situation.
You know, I still think it's kind of TBD. Listen, we're in an election year. There's a ton of headlines kind of swirling right now. We've seen similar instances with Facebook and some of the other larger players. So clearly it's something to keep on the top of mind. However, I think before there's a little bit more meat on the bone, we'd be a little bit early in making a decision one way or the other with regards to that.